Have you ever wondered how some people seem to get all the tax breaks while you're left paying more than your share? Here's the thing. Wealthy investors are not doing anything magical. They're using smart strategies with their investment portfolios to capture market gains and also create tax efficiencies. Today, I'm going to show you how they do it and how you can too. My name is Carmine Coppola, co-founder and partner at Strata Capital, where we manage tens of millions in tax-efficient portfolios. In this video, I'll break down the strategies we use so you can put them to work in your own investments and start indexing the stock market like a pro. Before diving in, let's quickly talk about tax assets. For a more in-depth explanation, check out the video link below, but simply put, tax assets are financial tools that reduce your current and future tax liabilities. They're valuable resources you can use for when the timing is right. In this context, we're talking about carry-forward capital losses, which can be a powerful advantage for investors. Let's first discuss what the majority of investors do. Most people invest by selecting an index fund, whether it's the S&P 500, a Russell 3000, or one of the many other indices, in the form of an ETF or a mutual fund. It's a passive strategy that aims to match market returns. For instance, if you had invested $10,000 on January 1st, 1999 in SPY, which tracks the S&P 500, and then added $1,000 monthly from then until now, your total contributions would be around $319,000, and your account would have grown to almost $1.5 million. Impressive, right? Now, there's nothing wrong with this approach. If you've done it, congrats. But here's the catch. That impressive growth comes with a hefty tax bill when it's time to sell. With $1.16 million in unrealized gains, you would owe around $175,000 to $225,000 in capital gains taxes when you cash out. Even if you wanted to pull a little money out, say to purchase a vacation home or to pay for your children's college, there would be a tax bill associated with the withdrawal. Same goes if you want to diversify your investments, since maybe you're older now. Or maybe you want to take less risk, but that pesky tax bill may prevent you from doing so. And if tax rates rise in the future, you could be facing even more of a tax bill. That's why you need to think ahead and focus on what you can control. Just because a stock index is up does not mean every stock in the index is up for that year. Looking at the last 5 years of the S&P 500, the index was negative in only 2 out of the 5 years. The first row shows the number of stocks within the index that ended with a positive return for each calendar year. There is only 1 year, 2019, where more than half the stocks in the index were positive for that year. So what does this mean? It means there is an opportunity to harvest tax assets. Looking at the down during the year column, you can see the number of stocks that were negative at one point during the calendar year. This does not mean that these stocks were down at the end of the year. It just means that at some point throughout the year, they were negative. This is where the magic happens. When a stock dips into negative territory, that is your opportunity to sell those stocks and harvest that capital loss. When you purchase an index fund, the fund manager is harvesting the tax assets when they rebalance. They get to keep the tax assets from your investment dollars, so they are benefiting from the tax loss harvesting, leaving you with large capital gains when it comes time for you to use your own money. Here's how you fix that. Take our client Jack. He wanted exposure to US stocks, so instead of buying an ETF that tracks the S&P 500, we bought the 500 individual stocks in his account, matching the index's weighting. This is called direct indexing. It gives us full control over what we buy, sell, or hold, while maintaining exposure to the market. By holding individual stocks instead of a fund, we can harvest tax assets whenever the opportunity arises. In 2023, for instance, Jack's $1 million portfolio tracked 95% of the index's performance. By the end of the year, his account was worth about $1.25 million, just under a 25% return. And we harvested almost $70,000 in tax assets. These are the valuable losses he can use to offset future gains. The key here is building up tax assets over time so that when you need them, they're ready. That begs the question, what can you use these tax assets for? Beyond offsetting portfolio gains, you can use these tax assets in other ways. Say you work for a company and receive stock as compensation that has grown significantly. Or maybe you invested in a high-growth name early on and have a large gain in that position. Harvested losses can help you sell and diversify that position without taking a big tax hit. Or maybe you own multiple real estate properties and you'd like to sell one, but the property value has increased drastically since you purchased it. You can use the tax assets you harvest from your direct indexing portfolio to offset the gains from the real estate sale. Depending on the amount of tax assets you have, there's a potential that you can sell the property and pay nothing in taxes at all. You can also use the tax assets to offset the sale of a business. Pretend you are a business owner that plans to sell your business in 10 years. A smart strategy would be to start direct indexing now, so over the next 10 years, you can harvest tax assets for the purpose of offsetting the capital gains due from the sale of the business. If you have also done the proper financial planning, you can forecast what you will sell the business for in the future and be a little more intentional with the amount of tax losses you harvest throughout the years. You are also hedging the risk of tax increases in the future. Right now, long-term capital gains tax rates are between 15 and 20%. What if that increases in the future? Well, if you are tax loss harvesting using a strategy like this, you are putting yourself in a much better position. Direct indexing also gives you control over what stocks are included in your portfolio. You can add or subtract any stock from the index that you either want to include or that you don't want to include. If you work for a company in the S&P 500 and receive stock as compensation, you can omit that stock to avoid further exposure. Or you can exclude the entire industry or sectors that don't align with your values, such as fossil fuels or tobacco. Of course, the more you customize, the further the portfolio drifts from the index, but that's a trade-off you can manage based on your goals. With all the benefits, there are still risks. The biggest one is triggering a wash sale, which is selling a stock at a loss but then buying it back within 30 days, which negates the tax benefit. You'll need to carefully track your transactions to avoid this. Another risk is not staying aligned with the index. You'll need to rebalance regularly to make sure your portfolio reflects the underlying index. Finally, when you sell a stock at a loss, you'll need to find a similar replacement to maintain your exposure. These risks can have a massive impact on taxes, risk, and performance of your overall portfolio. I would be lying if I said that this isn't a lot of work, especially if you do not have the technology and systems in place to properly execute. I urge you to carefully think about the risks before embarking on your direct indexing journey by yourself. At the end of the day, strategies like direct indexing give you more flexibility and control over your investments and financial situation. Sure, you could get by with traditional index funds, but why settle when there's a better way? Our goal at Strata Capital is to bring value-added insights and strategies to help you build wealth more efficiently. If you found this video helpful, don't forget to subscribe and feel free to reach out with any questions at admin@stratacapital.com.